If you trade options or you are thinking about trading options, you have probably heard people throw around words like delta, gamma, theta, vega, and rho. They sound complicated, but they are really just 5 gauges that tell you what can move your options price. In this video, I am going to break down each Greek one at a time, show you exactly what it measures, and explain how it affects your trade. Delta is your direction gauge. It measures how much an option's price is expected to move when the underlying stock moves $1. A call option has positive delta. That means if the stock goes up, the call's value generally goes up. A put option has negative delta, so if the stock goes up, the put's value generally goes down. If your call has a delta of 0.50, and the stock rises $1, the option should gain about 50 cents, all else equal. Delta can also be read as a rough probability. A 0.50 delta means the market is pricing about a 50% chance that the option finishes in the money at expiration. Gamma measures how fast delta changes. If delta is your speed, gamma is your acceleration. Let's say your call has a delta of 0.50 and a gamma of 0.10. If the stock rises $1, your delta does not stay at 0.50. It climbs to about 0.60. If the stock keeps rising, delta keeps climbing, and your option starts behaving more and more like 100 shares of stock. That is gamma working. Gamma is highest right around the strike price and near expiration, which is why option profits can suddenly accelerate on the last few days. Theta is time decay. It measures how much value your option loses each day just because time is passing. If you buy an option, theta is usually negative. Time is working against you. For example, if your option is worth $2 and theta is negative 10 cents, then tomorrow, all else equal, that option is worth about $1.90. Theta gets faster as you get closer to expiration, especially for at-the-money options. Sellers like theta because they collect that daily decay. Buyers fight against it. Vega measures how sensitive your option is to changes in implied volatility. Implied volatility is basically the market's guess at how much the stock is going to move. When uncertainty goes up, implied volatility goes up, and option prices go up with it. If your option has a vega of 0.15 and implied volatility rises 2%, your option could gain about 30 cents even if the stock has not moved. That is why options can get expensive before earnings or Fed meetings, and then deflate right after the event. Long options have positive vega. Short options have negative vega. Rho is the interest rate Greek. It measures how much an option's price changes when the risk-free interest rate moves 1%. Calls usually have positive rho, so rising rates help calls a little. Puts usually have negative rho, so rising rates hurt puts a little. In practice, rho is the least important Greek for most short-term trades. It only really matters for long-dated options like leaps, or when interest rates are moving hard. The important thing to remember is that these 5 Greeks do not work alone. They are a dashboard. A long at-the-money call before earnings is delta directional, gamma accelerated, paying theta decay, and exposed to a vega collapse after the announcement. A short strangle collects theta but has negative gamma if the stock moves big and negative vega if volatility expands. You do not have to master every formula. You just have to know what each gauge is telling you. If this helped you understand options a little better, hit the thumbs up and subscribe. If you want a deeper dive on any specific Greek or a real trade walkthrough, leave it in the comments. It is greatly appreciated and helps us keep bringing this kind of content.